Information presented on Sky News Real Estate is general in nature. Viewers should seek their own professional advice before purchasing products or services. Sky News Real Estate may receive a fee for commercial arrangements with companies featured in this programming. This is Sky News Real Estate. Smart investing.
Hello and welcome to Smart Investing. I'm Chris Gray. On tonight's show, the value of having a financial planner involved with your property investment decisions. We'll ask the question, why would you want to get rich slow when you could get rich quick? And if you're sick of your boring 9-to-5 job, what opportunities exist for those wanting to earn an income and still be connected with property and wealth creation? Well, joining me on the show tonight is Charles Tarbey, CEO of Century 21 Australasia, and Finn Kelly from Wealth Enhancers. Good to see you both. Thanks a lot for joining us. So look, great question to start with for you, Finn, is I guess what is a financial planner and why do so few people want to meet them or deal with them?
So a financial planner is someone who's invested in your success. They basically create a roadmap to build your wealth creation and then support you on the way. I think a big reason in the past why people haven't looked at them is that they haven't understood what they actually do. There's a lot of confusion in the industry and there's also a misrepresentation about how they often charge fees.
And probably one of the biggest reputations I guess they have, which is hopefully changing, is they don't like property and virtually never recommend it. And again, this is a generalisation.
No, it's actually something which is unfortunate. So traditionally in the advice industry it was based on investment commissions or insurance-based commissions, so they couldn't actually get remunerated for advising on property. Now the advice industry is changing. There's a lot of good young fresh blood coming in and they're actually focused on holistic advice, which is all focused about reaching your goals and whatever investment asset class is suitable for you. So property is a brilliant asset class, so we incorporate that. Unfortunately now some people have actually gone the other way where they're property, like developers and everything, are offering commissions to financial advisors, and now they're very invested in it. So you've just got to make sure that you're looking at where you're actually getting advice from.
Now, Charles, you've been around for a while. It's always been hard to get the right advice.
It's all right. I'm getting used to it.
Oh, no, you're still looking very young there, Charles.
Thanks.
But, I mean, I guess real estate agents, they've got a vested interest. They're trying to sell the property. Accountants are pro-property, but they don't know property in general. Financial planners we've always heard of. It is hard to get the right advice.
Look, it is. And the interesting part about it all too, Chris, is that real estate agents have been giving financial advice over the years, really not really knowing how to deliver it in the same manner that somebody's trained. So nowadays we can't do that, and we basically have to state that. But if you go backwards all of this period of time, as you've just heard, the financial planners weren't involved in the property industry, and they are thick right into it now, but the market's changing, so sometimes financial planners need to look for a quicker return or at least a dividend for their clients to some degree, and you're not going to get that out of real estate too easily. So it's now starting to shift back to the equity markets more because real estate's not offering that capital growth that everybody was getting before. I just think real estate practitioners, if they just stick with what they're doing with real estate, it's something we know, and with financial planning, if you do direct them in real estate, you probably don't see those people for another 6 or 7 years. So we're all sort of aligning, but to some degree.
Now, Finn, your business is called Wealth Enhancers, or we. What is your property philosophy, and what do you talk to your clients about? Because you guys are pretty pro-property, aren't you?
Yeah, we are. We see it as part of the holistic picture, and it's a tool to be able to create wealth and reach your goals. So a few things that we're focused on is making sure you know what you're actually trying to achieve out of that investment property. We do prefer investment properties over own homes, and there's a couple of reasons for that. One is the emotional attachment. Unfortunately, when you're investing into a property where you're living, you can pay too much, and you also want to keep paying for things to improve them, which often may not be getting the return. Another reason is that often you don't really want to live at a place where it's actually a good investment. So we say, like, live where you want to live and purchase a good investment property in another area. And then when we make sure that we actually have liquidity in their portfolios to make sure that there's unexpected expenses that can be accounted for and also rate increases. And then really go, all right, it's part of the strategy, stick to it and buy and hold. It does work.
Charles, again, history, it's always been buy your home and pay it off. Now for young people, I know you've got some young kids yourself and a lot of people you work with, quite often buying your own home isn't something that people can do, but maybe buying investments instead.
It is the way to go, and what you're saying is really sound advice, because a lot of people don't look at that way. They buy property, they overextend, they don't factor in interest rates, they end up in trouble, equity's not there, they can't borrow against it, so that approach is strong. And yes, I think what you're finding is that most young people are renting where they want to live, and they're being pushed to buy somewhere else. And it's generally because of the affordability issue. And my children got in early. I got them into real estate when they were 17, 18 years of age. Now they're late 20s and early 30s. So they've had the opportunity of capital growth and have been able to buy the second property. So I think that nowadays the younger generation have really got to start believing in real estate, not just buy it for the sake of it. I don't recommend you buy real estate just to get into the market, because I've seen people sit for 10 years without any capital growth. There are areas where there's still good, solid growth over a number of years. Just rent where you want to, stay within the affordability issues of living where you want to live, and then buy where you can afford to buy with some capital growth.
And I think that's a big part, is that traditionally people thought they could just buy a property and they were going to make money. That isn't the case.
I was on a flight with a young couple coming from Brisbane years ago, and I was sitting in economy, Chris, unlike some people I know, and they had all these brochures of all these properties, and they saw the logo on my shirt and started chatting to me.
Your subtle Century 21.
Yeah, just one here and a few places. And I said, where have you been? They told me. He said, we didn't buy one, we bought two. I said, why? They said, oh, because we liked the look of them, we thought we could. And, they might get lucky because they bought 4 or 5 or 6 years ago, and it was in Brisbane. But we all know that the Brisbane prices in the last 5 years have only increased capital growth by 25%. So maybe they didn't get lucky. And I think this is what is concerning. You get the brochures, the whole thing, it make it look easy, and people jump into something that's absolutely going to nail them, and they think real estate's the worst thing, when I know if it's done correctly, it's the best thing you can do.
And it's trying to get that independent advice. Now, Finn, with your business, so for a lot of financial planners, they concentrate on the baby boomers. They've got all the cash. Well, just like Charles was saying, as most young people haven't, you're going after the Gen Y, which typically haven't got any money. Doesn't that make the job kind of 10 times as hard?
It does make it a lot harder, but there's a few reasons why we've done that. One, we are Gen Y, so we are on the journey with them. We know exactly what challenges they're having and similar aspirations. Two, the actual demographics are changing a lot. So in 2020, over 42% of the workforce are going to be Gen Y. Gen Y have just taken over as the largest generation in Australia at the moment, and that's because of migration. They're spending over 50% of discretionary spending, and they're actually about to receive the biggest intergenerational wealth transfer this country's ever seen. So the demographics are there, and they're fun to work with. Hard work, but it's rewarding, and we want to be able to focus on building their wealth rather than just making people wealthier.
Now, there's a lot of books around how to deal with Gen Y as your staff, and I'll jump to you in a minute, Charles, but how do you treat them differently? How do you educate a Gen Y person about wealth creation versus a baby boomer?
So it's quite interesting. Everyone thinks that Gen Y are just technology advanced and that's all they want. They want it that technology is enabling them to get a better result, but they still want the human interaction. So we focus on a lot of technology. We have face-to-face interaction. We do a lot of video, so we don't do face-to-face client meetings anymore. We're focusing on just you're busy, let's do it by video and make it short and sweet. And we do a lot of education. We've just launched an online free course to be able to educate the whole masses. We have a WeTV, a TV program for them. We do a lot of blogs so they can pick and choose what they want. And then the final thing is that we actually sort of handhold them, give them advice, but then collaborate with their expertise, because they actually are quite knowledgeable. So it's a collaborative environment.
I love the words wealth transfer. Now that might
is that what your kids are hoping for?
that might equate to my will saying, I'm going to change my will now based on that. Being of sound mind, I spent all my money while I was alive. Wealth transfer, great words, eh?
So you'd have a lot of Gen Y in your office and also within your real estate.
Yeah.
Have both you and I guess your real estate offices had to change the way they deal with stuff.
I think many of the Gen Y in real estate nowadays have focused too much on their image and focused too much about how great things are for them. And in reality, there's a lot of hard work coming up for those people. So we've been trying to educate them on getting to understand the basics of real estate, and those basics will help them buy property, but they really need to establish their foundations as real estate practitioners, not as social media warriors, which has been concerning me for the last few years.
Yeah. Well, let's have a look at some of the numbers. What's the mood of the property market this week?
It's still very strong. It's not as strong as this time last year. The clearance rates for Australia were 70.5 on a national basis. That's still a very strong movement, but it was 78.4 a year ago, exactly this time last year. So there's definitely a decline of just over 10%. Melbourne and Sydney had exactly the same clearance rates with 71.7%. The Melbourne market outstripped Sydney again. They had 1,610 auctions and Sydney had 1,221 auctions. But interestingly enough, the most outstanding real estate market for clearance rates is Adelaide, 74.9%, and they had 107 auctions, so it's a good sampler. And we've talked about Adelaide and Perth, and also interestingly enough, Adelaide and Perth are the only two capital cities that achieved a better clearance rate this week than they did this time last year, and Adelaide's done it 3 weeks in a row. So those markets have still got some good movement in them as far as I'm concerned.
And again, some properties are selling well over reserve and some people aren't getting any numbers. So
some people aren't getting at all. Yeah, some people aren't getting anybody at all. If you're advertising your property with a price, quite often that's actually a deterrent right now.
So what's happening with homes advertised for sale?
Man, fantastic. We've had, what, 5 weeks now? This week it's 7.05% up on this time last week. Now, the stats also going back exactly this time last year, we have a plus 4.39% more stock now than we had this time last year. Fewer buyers. Fewer activity from overseas. So that's all telling me that we're heading into a nice soft market where price movement is going to be generally, it's going to be there, but there are going to be some adjustments before it gets there.
And again, that's when the agents kind of move into their own, that the difference between the good agents and the bad agents.
Absolutely, Chris, in any industry.
Yep.
Yeah.
How about rent price movements?
Now, I've got some interesting stuff here, because you know I keep these figures every week because I've got such a boring life. And 2.52% was the increase, same as last week, but Adelaide was the best one. Hobart was the best one with 6.02%. They're still getting that runoff from what's happened in Melbourne and so on. But here's the big stat that really made it stand out for me. Perth, since I put the charts together in January 2014, so 4 years, Perth has had a negative 19.56% in rent. That's how far it's declined. So that tells me it's got the chance now to move upwards, which we've been talking about for a while. But Hobart, which is one I think will go the other way, had a 27.12% increase in their rent values in the last 4 years. So it's really interesting to watch the stats.
And again, a lot of people have been talking about Hobart and tipping that as well.
Yeah,
again,
it's a scary one. A little bit scary.
Vacancy rates?
Outstanding. Melbourne 0.68%. It's been brilliant for quite some time. Sydney jumped 1.77%. But the one that, again, Perth, which we've been watching for quite some time, that was 10s, 11s. Now finally under 7, 6.95% for the vacancy rate for Perth. So that's a 3.13% average over the 3 capital cities. So congratulations to Perth.
Wonderful. Thanks for those figures. Now, before we go to the break, Sarah, your CEO of the business, has written a book called Get Rich Slow. Why would anyone want to get rich slow?
I know the normal thing is you want to get rich quick, but we all know that rarely actually happens. So we've built a framework which is all about the actual steps that if you follow these, you'll have a very high success rate of getting wealthy. And it's more than just actually building financial assets. It's actually about living with intention, living within your means, and doing something great with that money that represents your goals and values.
Money's a lot easier to make than it is to keep. And I think people don't get that. Now, I watch people who win a lottery, you always hear about them, a year later they got nothing. It's like the maker has gone, oh, we made a mistake, we'll better take that money off them. I think slow money, which is how I built my business, has been very progressive over the years. And I build that foundation with it so that I can always lean on that foundation or sit on that foundation.
And the people that chase the fast money in property, they're the ones that probably suffer later on.
You can see it in their eyes, Chris.
Yeah, they don't tell you those stories.
Exactly. Well, coming up, how property investing can help you escape the rat race, and a reminder, you can get a free digital copy of my book, The Effortless Empire. Just go to yourempire.com.au. We're going to take a short break, but we'll be back soon.
You're watching Sky News Real Estate. Smart investing.